Hello everyone. Welcome to the Tax Tutor video on tax projections and tax planning. In this video, we're going to cover how to do tax projections for clients and how to do tax planning and the importance of doing those things for your clients. So first off, the overview. Here is what we're going to cover in this video today. So first off, we'll talk about what is the purpose of tax planning. Then we'll go through the steps of the tax planning process. This will include that we obtain the year-to-date income, we estimate income for the remainder of the year. So depending on when we do that projection, we'll have our year-to-date and then we have the rest of the year that we need to estimate the income for. Then we'll estimate the deductions for the year. We'll check on the status changes for the client, any tax status that changes they may have. We'll go through that we used our tax projection software to help us to run these numbers. And then we do a projection using multiple scenarios. Then we review that projection with the client. We update that projection as needed, whether that's from talking with the client or if we get new information before the end of the year, we'll update that. And then we assist the client with making estimated tax payments. And so that's the overview. Those are all the things that we'll go through. Now, first off, let's talk about the purpose of tax planning. Why do we do it? Well, first off, tax planning and tax projections are some of the services that clients value the most. If you think about tax compliance, which is completing tax forms, many clients view that as a compulsory type service and not a value-added service. It's something that they're required to do by law and not necessarily something that they put a lot of value into doing. They value being compliant with the law, but other than that, it doesn't really add any value to them, to their business, to their personal lives. Providing tax projections and tax planning gives professionals an opportunity to add value to clients. Many of the reasons clients do not return to tax preparers the following year is due to clients not feeling that they are being taken care of by the tax preparer. Now, a lot of times clients will give reasons that they didn't come back. Sometimes that could be a price reason. Sometimes it could be they just didn't get the service that they were hoping for, or a number of different reasons. But even a price reason comes back to not feeling like they're being taken care of, not feeling like they got the appropriate value for what they paid. If you think about cars, right? So cars can be valued very differently. You can have a car that's worth $10,000 and you can have a car that's worth $100,000. But if you really think about that, the car is meant to just get you from one place to another, right? From point A to point B. That's what the car's purpose is. So why do people pay $100,000, $200,000 for a car when a $10,000 car will get them from point A to point B? Well, the reason is there's things behind that more expensive car that somebody values, and so they'll value paying $100,000 to $200,000 for a car. Same thing happens with tax returns. You can have a $100 tax return and you can have a $1,000 tax return. They can be pretty similar in completing them, but if you can really show the value of why you charge $1,000 for a return or something like that, why you charge more money for a return, then the client will value that. So even when a client says, hey, they have a price objection, it still comes down to that they didn't feel like that they were being taken care of, that for whatever price they paid, they didn't get the value of that price that was paid. And when you help clients with tax planning, those clients feel you are invested in them and you genuinely want to help them. You go from somebody who is just performing a quick service like preparing a tax return and collecting money on it, and you become someone who is valuable to them, somebody who's helping them, somebody who is interested in them and wanting them to succeed. And that helps them to have better feelings towards you and be more willing to use your services. And in return, clients are more willing to invest in you and keep returning to you to use you each year or each month or how often that they use your services. Tax planning gives an opportunity to solve tax issues while there is still time. I can't tell you the number of times that clients have come to me in February, March, April, given me their tax information and said, oh, by the way, this happened last year. And do you have any ideas of how we can reduce tax on it or something? It's really hard to reduce somebody's taxes in February, March, April when we could have done something about it had we known about it in October, November, December of the year before. So it gives you an opportunity to get in there and help resolve some tax issues before while there's still time to fix those. You should really know what the tax return will look like before the year is over. This is something that we emphasize with our clients about the tax planning, and that is that tax preparation should become merely completing the forms to get to the pre-planned result. So that's what we tell our clients to say. We like to know what the tax return is going to look like by the end of the year so that when we get into the new year and prepare the return, at that point it's just putting numbers on the paper because we already know what that result is going to look like. And I do this all the time. I run projections for clients in the fall, October, November, December, and then when I'm preparing their returns in February, March, April, I get that return done, and then I'll go back and look at the projection and say, okay, how close were we? Where were we off? If we were off, why are we off? What happened? What changed? Because if the client comes and says, well, hey, back in the fall you said it'd be this and now it's this, what's the difference? I like to know why we have a difference there and how we can prevent that from happening in the future. So those are the reasons why we do tax planning to better help our clients that way. So what is the process? What process do we go to do tax planning? So as we map this out, it'll be a 12-step process that we go through. And I have a slide on each one of these 12 steps. So we'll go through this entire process quickly here, and then we'll spend more time in each slide going through each of the 12 steps and how each of them work. So we first start with the year-to-date income. We want to know where they're at this given point in time. Then we estimate the income for the remainder of the year. We want to know where they're going to be at by the end of the year. If income includes W-2 income, then we want to estimate the federal and state withholdings. That's if applicable. Some states don't have an income tax, so we don't have to worry about state withholdings in those states. But federal withholdings generally apply to all W-2 income. We estimate the itemized deductions. And so you can see here we've talked about a little bit of the business, started with year-to-date income, estimate the income. Projections are all run on an individual level because individuals are the ones that pay taxes. So things that go into individual return enter in. The first two items can be business, where we start with the year-to-date business income and then estimate the business income for the remainder of the year. And then we get into the personal side with W-2 income, itemized deductions. Then we check on changes in dependence and marriage status. Again, something that happens at the individual level because projections are run on an individual level. We use tax projection software and import information from a prior year tax return if that's available. We enter current year information into the tax projection software, and that would be the information that came from steps 1 through 5 above, where we get the current year income or the year-to-date income, estimate the remainder of the year, and all those other things go into that. Then we want to create multiple scenarios. We want to see what happens if we change things in that tax projection. Now for 2020, we need to pay particular attention to PPP loans and other assistance that was received because we have some special rules for these, and we'll get into those a little bit later. Then we review results with the client and we modify our projections as needed. And then we update the tax projection as new information comes available. Maybe something happens in the business, maybe a contract that was expected to come in does not come in, or the other side of that, maybe additional income comes in that wasn't expected, and now we've got more income and more taxes to plan for and to look at. We want to calculate estimated tax payments as needed if the client needs to make some of those estimated tax payments. That's a key part of doing tax projections and tax planning, is making sure that they're getting their estimated tax payments in on time. And then finally, we'll instruct the client on how to make the estimated tax payments. And again, that's as needed. If they need to make them, then we can help show them how to make those payments. All right, so first off, we've got year-to-date income. For a business or rental income, we want to get the most up-to-date financial statements that are available. So this could be through their accounting software, through QuickBooks or Xero or FreshBooks or whatever they use. It could be downloading bank transactions if that's where, if they don't really use accounting software. However it is, we just want to get the most up-to-date business or rental income, or both if they have both a business and a rental, whatever they've got, we want the most up-to-date information there. Then for W-2 income, we want to get the most recent pay stubs and see what they've earned year to date and what they've had withheld year to date. For capital gain income, we'll check the brokerage statements or ask the client to get information from their financial advisor for those. And then if interest and dividend income is consistent from year to year, then we can use the prior year number as an estimate for the current year. And we'll check with the client to make sure there's been no significant change in their investments from one year to the next. So if you think about this, it would be basically, if they had to file a tax return right then, what information would go into that? What income have they earned so far? What deductions, things like that. What is their current tax status if they had to file a tax return right then that day? Then we estimate the annual income. So to do that, if it's available, we review the income from the prior year and compare it to the current year. So to do this, I like to look at monthly income from the prior year compared to monthly income in the current year. So as an example, if I pull up a prior year P&L and I run it by month, so I'll have each month, January, February, March, all the way through December, and I see what that monthly income looks like, and then I pull up a current year P&L and I'll run that by month, and that will show me what income looks like by month for the current year, and then I'll start comparing those two. I'll say, okay, how does January look between the 2 years, February, March, and look through those, and then we get into the current month. So, let's say that their financials are up to date for the first 3 quarters of the year. They're up to date from January through September. And then we just need to project out the last quarter. So I'll look at the prior year, January through September, how much income was earned during that time. Look at the current year, January through September, what was the income earned this year. And then I'll look at the last quarter of the prior year and say, okay, how much money was made in that last quarter? How much money was made in October, November, December? And then look at it for this year. And then we want to ask the client on here if the current year is better or worse than the prior year. Is this last quarter looking like it's going to be really good? Does it look like it'll be similar to last year? Does it look like it's going to be worse than last year? And start to get a feel for what's there. Now, obviously, if this is their first year in business, you won't have the prior year to look at. So you'll just have to ask the client, what do you think this last quarter of the year looks like? Where do you think you're going to be? And maybe you get a range of, well, it could be as good as this, it could be as bad as this, and that's fine, because when we get into the scenarios in the tax software, we can run different scenarios and say, well, this is what it looks like if you make this much, this is what it looks like if you make this much, and start planning that way. So you want to ask the client to estimate income and expenses for the remainder of the year. So if it's just kind of hard to figure that out, ask the client to help you with that. They should have a pretty good feel for what the year looks like for them. And then, if applicable, review fixed asset additions and estimate depreciation expense for the year. So if they've added some equipment or a vehicle or something like that, then we can look at that and estimate that for the year. And then consider if fixed assets can be and should be fully expensed. So the can be, if it's a rental property, if you have like a rental unit, like a real estate real property, or if you've got like a commercial real property, some kind of real property there, those generally can't be expensed in the year that you're purchased. Those need to be depreciated over a period of time of years. But there are many things that can be expensed fully in the current year. Machinery and equipment can, some vehicles can, not all of them. So you just kind of look at that and see what can be expensed and what would need to be depreciated and try to estimate that number. Then you've got W-2 income. So if the client happens to have a job or something like that and you need to estimate their W-2 income, then you want to get the pay stubs. So you use the pay stubs to estimate the W-2 income for the remainder of the year. And so you can look at those pay stubs, and from those, I generally try to get 2 pay stubs, and then that way I can see the periods that we're dealing with, because people get paid in different periods. The most common 2 ways are to be paid twice a month and to be paid biweekly, which means they're paid every 2 weeks. If somebody's paid twice a month, then you know they're going to get 24 paychecks during the year because they'll get 2 paychecks each month. If somebody's paid biweekly, then they'll get 26 paychecks each year, because when they're biweekly, then it works out that they get 26. So that's important to know as you project out the income, because you need to know how many paychecks you need to project it out to. So you need to know if it's 24 or 26 pay periods in there. And then you run that calculation by the client to make sure it sounds correct to them. So you say, does this look right? Because they could get a bonus or commission income that comes in during the year that would increase that. Then you want to estimate their federal withholdings for the year. What do they expect to have withheld during the rest of the year? And then that's critical to know as well, their pay period, because if it's 24 pay periods, you need to know how many pay periods you have left to estimate that withholding. If it's 26, you need to know that number so you know how many pay periods are left to estimate that. Then if a client lives in a state with a state income tax, then estimate the state income tax withholding for the year as well, so you know what that's going to look like. Then you want to estimate their itemized deductions. So ask the client if they have any significant medical expenses this year that will put them over the threshold for claiming those expenses as an itemized deduction. That's generally pretty rare to have somebody that can itemize medical, but every year I run into at least 1 or 2 clients that are able to deduct their medical expenses as an itemized deduction. So as you're doing planning and preparing, it's a good question to ask. Estimate the state taxes paid is another part of it. And you can do that by looking at the state income taxes that are being withheld on their pay stubs. And then you can also take your state income tax withholding for the remainder of the year, so the amount that you project out. So you got the year-to-date withholding, your projected withholding, and then any state taxes that were paid when the state return was filed would all be deductible state taxes. You also have... and then if a client that lives in a state that does not have a state income tax, then you can use an estimated sales tax instead of income tax for that. And you'll also look at their property taxes as well. So you'll estimate their property taxes paid, or use actual if known. They may have already paid their property taxes for the year, or they may have gotten that assessment. Generally, when we're doing tax planning, it's later in the year, so they generally will know what that number is. In some states and counties, you can actually look that up on a state or county website and see it there. So it might be something quickly that you can look up, or you can ask the client for that as well. Then you want to estimate their mortgage interest for the year. And sometimes you can just use the prior year mortgage interest, but you want to check, make sure the client hasn't refinanced or paid off a loan or gotten a new loan or something like that. And then if their mortgage balance is over the limit, then you need to calculate the deductible amount. So before the Tax Cuts and Jobs Act, the limit was $1 million. People that had mortgages from back then were grandfathered into the $1 million limit. With the Tax Cuts and Jobs Act starting in 2018, they reduced that limit down to $750,000 on the mortgage. So you just have to make sure if they're over those limits and when they got the mortgage, that you might have an amount that you need to bring down. And then you want to estimate their cash charitable contributions. So a lot of times these are different scenarios we run where a client will say, well, what would happen if I gave this much to charity or this much? And so you want to kind of find out what their year-to-date charitable contributions are and what they project out for the rest of the year. And then estimate their non-cash charitable contributions as well. Are they going to give donations to Salvation Army or to Goodwill or anything like that? And then check their tax status changes. So this is, you want to check and see if their marriage status changed during the year, because the rates for somebody single is very different from a married filing joint rates. And so that would make a big difference in your projection estimate. Check if there was a change in dependents during the year. So this could be, did they have any new dependents or any children born during the year? Are any dependents now old enough that they're going to claim themselves? So are they going to lose any dependents on their tax return coming up? Are any dependents no longer eligible for the child tax credit? You're going to want to know that because right now the child tax credit is $2,000, but when that rolls off, then it drops down to a $500 credit. So that's a $1,500 swing in tax that you're going to want to know about and be able to plan for and let the client know that that's coming up. All right, and then we get into the tax projection software. We're going to want to enter or import the prior year tax info into the tax projection software. So now most tax preparation software includes tax projection software that you can use as part of that. I've used at least 4 different softwares. I've used UltraTax, Lacert, Drake, and Intuit ProConnect. And all 4 of those have a tax projection module or system that's either built in or is a separate program that comes with that program that you can use to make tax projections with that. If whatever software you use doesn't have that, then you might want to look at something different, or you'll find some projection software out there, but generally it comes with the tax preparation software. Now, if it's available, you want to import the prior year tax info into the tax projection software. So all the ones that I've used, all the ones I mentioned a moment ago, they all have the ability to import the tax return directly into the tax projection software. So for an example, I've got all my clients that I've gone and prepared their returns for, they all are sitting in my tax projection software, or in my tax software with their returns done. When I go and start a tax projection for them, I will import that tax return information into the tax projection software, and it will start there. It will show me 2019, what it looks like. So I have a good, strong starting spot there. And then if importing is not available, then you can input the prior year information into the projection software. And then you want to double check the import or input to verify it agrees with the prior year return. So even though this will speak directly with tax projection software, or with the tax preparation software, it's not always 100%. It's not always flawless. Case in point, I did one the other day where I brought it into the tax projection software and it was off by a few things. I had to adjust a couple things in there. In this particular one, the medical expenses didn't come through quite the right way, so I just had to change that number, and then everything worked just fine. So you always want to make sure that it agrees. And then once you have a good, solid current year, then you input the current year info into the tax projection software. So we create a current year projection starting with the same numbers from the prior year return. And then we update the current year numbers using the information from steps 1 through 5. So the way that this works is that we basically take that prior year information that's in there, we then roll that into a current year projection number. So basically in our tax projection software, we have a prior year and a current year, and they both say the exact same number, so that we know that our current year is starting where our prior year was. And then we go back through those steps 1 through 5, where we get an estimate, or we get our year-to-date income, we estimate the future income, we estimate our W-2 income, we estimate our itemized deductions, and we check on any tax status changes such as marriage or dependents, and we put all of that in and we update our current year projection with those numbers. So now we have a prior year that was true to the tax return and our current year that's showing our current year numbers. And then double check each number to verify it's correct. So I always go through and I make sure, okay, here's our W-2 income. Is that the right number? Is that the number that agrees to what we've projected? Here's the business income. Is that the right number? Is that agreed to what we projected? And then you want to pay special attention to tax payments. So most of the tax projection softwares that I've used, when I roll forward, say their prior year into the current year, just to have all the numbers the same, it also rolls forward tax payments. So if they've made estimated tax payments or extension payments, then it will roll them over and put them into the current year projection. And so I'll usually have to go and delete those out if they haven't made those, or at least update them for whatever payments they've made so that those are correct and we're not using the prior year payments in the current year, because that will throw things off. All right, now once we have everything in the software, then we go on to create multiple scenarios. And to be honest, this is where you really add the value to the client. So first off, we create a scenario showing the worst case scenario. So this is what their taxes would look like without any tax planning done. It's just the raw numbers, we put them in, this is what it looks like. Then we create a scenario using tax planning ideas to show the client how much tax can be saved by implementing tax planning. And this is where you really start to show your value to a client, where you can say, hey, you're going to owe X amount of dollars. However, if we do such, this, and this, you can get your tax bill down to that. And then the client looks at that and says, well, you saved me that much money. And now they value you and your services so much more. Now, I mentioned that the PPP was going to create a problem. So we want to create some scenarios showing the difference with PPP expenses deductible and not deductible. So here's kind of the deal that's going on with that. So when the law was passed allowing PPP loans to be made, it's expressly says in the law that the forgiveness of the PPP loans would not be considered income, taxable income, which you kind of have to go back and look at the IRS laws and rules. And it says, the IRS, the tax law says that when you are forgiven of debt, it is taxable to you. So Congress, knowing this, they said, hey, we don't want this to be taxable, so we're going to put in this law that the forgiveness of this loan is not taxable. And so the IRS looked at that and they says, oh, okay, fine, it's not taxable. Well, in that case, then, any expenses that paid with the PPP loan are not deductible. Or any expenses that are forgiven, or however that works. And so that's created this scenario where it's basically made the PPP loans taxable, if you think about it, because if you cannot deduct the expenses that you pay with these loans, then you're basically recognizing taxable income. So IRS found a way to basically make the PPP loans taxable without making them taxable, with denying the expenses that are paid with those loans. So that now creates an issue where clients will have to pay more tax. They basically get taxed on the PPP loan funds that they received. Congress, when IRS came out with that, Congress said, well, we're going to pass a law that makes them deductible. But as we sit here, as I record this late in October of 2020, that has not happened yet. And so we are waiting to see if Congress will pass that. If they don't, then we're dealing with a deductible. So that's why I say run two scenarios. One that says, okay, if your PPP expenses are deductible, this is what it looks like. If PPP expenses are not deductible, then this is what it looks like. So the client can start to plan and get ready for that in the event that they do have to pay taxes on that. Quick example on that, I did run a projection for a client. They had $30,000 of income in their business, and they had these PPP loans, and the difference between their tax with $30,000 of income, the tax on that was virtually nothing. But with their PPP loans, when we added those in, or we disallowed the expenses to be deducted for those, it resulted in $100,000 of tax owed, which was a big difference. So basically, they had to pay tax on $30,000 of income because of this PPP loans, which they've already spent on PPP expenses. So I foresee this kind of creating a big issue if Congress doesn't get it fixed. Now, what are some ideas for tax planning? So we'll go through a lot of these. We have videos for each of these in the Tax Tutor program. We'll go through each of them in detail, but we'll just kind of mention them here. We've got a change in entity, so maybe they want to go to an S Corp or a partnership or a C Corp or some other type of an entity. That could be a tax planning. Home office deduction. If they're not taking a home office deduction, we can run a scenario showing them what it would look like, how much tax they would save if they had a home office. Then we can go through charitable contributions. So we talked about this a little bit, where a client may want to do some charitable contributions. You could say, okay, this is what it would look like if you did $30,000 in contributions, or $5,000, or $100,000, or whatever that number is. You can run different scenarios there. If they're considering purchasing a vehicle for the business, we can run that and show them how much money that would save them. If it's a cash versus accrual method of accounting, so you can change those methods. You can't change them back and forth every year, but you can change them from time to time as needed. So if it's looking like one method is better than the other, we can run projections that say, hey, right now you're on the accrual method and this is how much tax you're going to owe, but it looks like the cash method might be better for you this year. So if we switch you to that, this is how much it could save you in tax. Then purchase of machinery and equipment or other large fixed assets. So maybe they're looking at a piece of machinery or something that they need, and you can run a projection, you can run a scenario showing what it would look like if they bought that piece of machinery or equipment in their business. Now, if they have some real estate and they're thinking of selling it, you could run a projection that would show, or you can run projections and scenarios showing, okay, this is what it looks like if you do a 1031 exchange. This is what it looks like if you don't do a 1031 exchange, because that could help them to maybe either do the 1031 or decide not to do it, depending on how much tax they're going to have to owe. You could run a scenario with doing the Augusta loophole to help them save tax there. You could do a cost segregation. So if they own commercial or rental property and they haven't done a cost segregation study on that, then that's another option, another scenario you could run, what it would look like with the cost segregation in it. You could run a scenario based on if they hired children. So if they were able to hire their children and pay them, this is what the tax would look like versus not. You could look at captive insurance companies if that's an option that would benefit them. And then there's a number of credits that you can help them with. There's R&D credit, the FICA tip credit for restaurant owners, and then the WOTC, or the Work Opportunity Tax Credit, that you could put in there and show how those run. And again, we have videos for all of these in the Tax Tutor program that goes through all this to help clients save money on taxes on those things. And then we review with the client and make modifications. So we want to communicate the results of the tax projection with the client. And in doing that, we want to show the client the result without tax planning and say, hey, based on the numbers, this is what it looks like. And then we go through the tax planning scenarios with the client and show how each scenario reduces taxes. So you can say, hey, if you had a home office deduction, this is what it looks like. If you hire your children and you're able to pay them this amount of money, this is what it looks like. You can go through all those scenarios that we just walked through and show them what it looks like to implement those things. And then we make modifications to scenarios based on client feedback or questions. So a client might come and say, hey, I'm interested in giving this much to charity, or I'm interested in hiring my children, or I'm interested in certain things. And maybe if they're interested in hiring children, it's an amount of what they could reasonably pay that child this year. So you have a discussion with them about how many hours the child could work, what kind of duties they could do, and you get into a reasonable compensation type of a discussion with them. And then you can update that scenario with that reasonable number. And then you work with the client to implement tax planning to make sure the client saves money on taxes. So you don't just want to give them ideas and leave them be, because guess what's going to happen? When you get into to do the tax returns the next year, you're going to say, oh, hey, great, the year's over. How did you do with all those things that we talked about? And the client's going to say, oh, I didn't have time, I didn't do anything. And so you want to work with them to make sure that they're implementing the things you're coming up with and actually saving that money on their taxes. And then we update the projection as new information becomes available. So depending on when projections are calculated, updates may be needed. Projections calculated in September and October should be updated in November, December to verify that the original projection is still accurate. And then we calculate estimated tax payments for the client as needed. If they owe some money and are going to run into some penalties, then we'll want to do some estimated tax payments. So we review that projection, see if any are needed. And then estimated tax payments are due in April, June, September, and January. So projections can be calculated before the due date of each estimated payment to calculate how much should be paid in estimated taxes. So in practicality, in April, we generally don't run projections then. We could if something's really off, but generally we're kind of looking at the prior year type safe harbors in April June, we might do some clients, but generally kind of still keeping it to safe harbor. September, we get a little more proactive in looking at projections and figuring out estimated payments, because September is another estimated payments due then. And then certainly by the January estimated payment, we're going to want to know where they're at, because maybe they've already made 3 estimated payments and they've got a big loss, or they've got incomes down this year and they don't need to make a January estimated payment. Or maybe income's really high and then they want to get that paid in. And so we can up the January estimated payment, or we can keep it the same and then just let them know that they're going to owe more tax in April. So anyway, we're just kind of looking at those payments, making sure that they're being taken care of. And then some states require estimated tax payments, so make sure to consider state estimated payments as well. So that will all be dependent upon state. Of course, some states don't have any income tax, so you don't have to worry about it for those. And some states do not require estimated payments. Like I live in Utah. Utah does not require estimated payments. You can pay the full amount of tax due on April 15th of the next year when the tax return is due, without any penalty or interest whatsoever. So it kind of makes it nice that way. But then the downside is clients have to pay their entire tax bill on one day of the year. And then we want to instruct clients on paying estimated tax payments. All right, and then finally, we want to instruct the client on how to make those estimated tax payments, how to pay those. So we help the client make any federal estimated tax payments, and we do this by, if the client wants to pay by check, then we create the payment coupon for them using software or completing Form 1040-ES. So 1040-ES is the payment coupon that goes into the IRS. So we can help them complete that and send that in. If the client wants to pay online, then we help them understand how to properly make the payment at irs.gov/payments, where they can go and pay online. I prefer that method. You get a confirmation back that a payment has been made. You can make it really quick and easily. You're not relying on the mail or anything like that. It's really easy. But you just want to give a second. There's a lot of options when a client goes to that website of how to make payments. And so in my practice, I've recorded a video that shows them how to go through and do that, which buttons to click, which options to select as they go through, so that when they make that payment, it reduces their chance for messing it up. And then help the client make any state estimated tax payments, and then check with the state requiring estimated tax payments to see options for making the payment. Maybe they require them all to be made in check. Maybe they require them all to be made electronically. It just kind of depends on the state and what they require for the state. So yeah, it's like what we have there. Yeah, some require electronic payments, while others only accept payments by check. So check with the state and see. And so that completes our tax projection, tax estimate video as we go through that, where we talked about why we do tax planning and then the 12 steps that go into our tax projection and tax planning.